close your eyes for a second, right? And just imagine how money is created.
Okay, I'm picturing like a giant vault.
Right. If you are like most people, you're probably picturing this highly secure government facility. Massive printing presses rolling out these, sheets of crisp, green $100 bills.
Oh, yeah. Guards everywhere?
Exactly. Maybe an armored truck idling in the background. It feels very physical, right? It feels tangible.
Because that's what we see in movies.
But what if we told you that right now, every single time someone gets a loan for a car or signs the paperwork for a college education or gets approved for a mortgage on a new house, new money is literally being created out of thin air.
Wait, out of thin air?
Out of thin air. No printing presses, no armored trucks, just a bank loan officer typing a few numbers into a computer screen. Welcome to the Missing Lessons, where we explain what school never did.
Because, we interact with money every single day, right?
Yeah.
But its actual origin is almost entirely misunderstood by the public.
It really is. We obsess over making it, saving it, spending it, but we rarely ask where it actually comes from. And money dictates almost everything in our lives.
Yeah, where we live, what we eat.
Exactly. How we spend our time. Yet the true mechanics of where it comes from are basically hidden in plain sight.
Which is wild when you think about it.
Right. Understanding how money is truly created is like the ultimate cheat code to understanding how the entire global economy functions.
If you're enjoying the Missing Lessons, make sure to follow the deep dive, leave a rating, and share it with someone who might find it interesting. It helps us create more deep dives and reach more curious minds.
So, to understand how money is actually made, we first have to, we have to destroy a myth.
Okay, lay it on me.
We need to talk about the classic piggy bank illusion.
The piggy bank illusion.
Yeah, from the time we are kids, we're taught this very specific, very simple model of banking. We think of a bank as a giant vault.
Right, like the Scrooge McDuck vault.
Exactly. The story goes like this. Savers, people who have extra money, walk into the bank and deposit their cash.
Makes sense.
The bank takes that physical cash, locks it in the vault, and keeps it safe. Then, when a borrower comes along needing a loan, the bank just walks into the vault, takes out that exact same physical money that the savers deposited, and hands it over to the borrower.
So in that view, the bank is basically just a middleman.
Right, a storage unit that occasionally lends out the items stored inside.
Wait, so when I put $100 in my checking account, it's not just sitting there waiting for me.
It absolutely is not.
Mhm.
And this brings us to a fundamental concept called maturity transformation.
Maturity transformation. Okay, that sounds like heavy financial jargon.
It sounds like it, yeah. But the idea is actually quite elegant. When you deposit money into your checking account, you want to be able to access it on demand, right?
Yeah, I might need it tomorrow to buy groceries or pay rent.
Exactly. This is a short-term liability for the bank. They owe you that money whenever you ask for it. But borrowers, they don't want short-term loans.
Right, when someone buys a house, they need a 30-year mortgage.
Yes, they need a long-term asset. So the bank's magic trick, the maturity transformation, is taking your short-term deposit, which you can demand at any time, and transforming it into a long-term loan for someone else.
So they're essentially taking my grocery money and locking it up in someone else's house for 30 years.
That's exactly what they're doing.
But that only works if we don't all show up on the same day asking for our grocery money back. It relies entirely on human behavior.
And the assumption that most of us will just leave our digital numbers alone.
Yeah.
And the math backs that up perfectly. Yeah.
Right, because on any given Tuesday, only a few people will actually withdraw cash.
Exactly. The incoming deposits usually balance out the outgoing withdrawals, allowing the bank to safely tie up the majority of the funds in long-term loans.
Okay, so far so good.
But here is the hidden trapdoor in that entire system. Matching savers and borrowers is only half the story.
What's the other half?
Well, the piggy bank illusion assumes banks can only lend out what they already have in the vault.
Right.
The real shocker is what happens when they don't have enough deposits to match the loans they want to make.
Let me stop you right there. If a bank wants to give a borrower a $10,000 personal loan, but they don't have $10,000 of new deposits sitting around, they can't just write a check. The math literally doesn't add up.
They just make it up. Literally.
Wait, what?
Let's look at the actual mechanics of a modern loan. When you go into a bank and get approved for a $10,000 loan, the loan officer does not walk to the back, open a safe, and hand you a briefcase full of pre-existing cash.
Obviously not. It's all digital now.
Right. Instead, they sit at their desk, open your account on their computer, and type in a 10 followed by 3 zeros. They make an accounting entry. They credit your checking account with $10,000. But here's the kicker. Before their finger hit the enter key, that $10,000 did not exist anywhere in the universe.
Wait.
After they hit enter, it does.
Hold on, they just type it into existence. Is it even real money at that point?
It is as real as any other money in our economy. In the financial world, this is called book money.
Book money.
Or giro money. It's digital money, created by the sheer act of accounting. You can take that newly typed $10,000 and use it to buy a used car. Or pay your college tuition.
Or buy groceries.
Exactly.
Mm.
And the person receiving the money accepts it as perfectly valid payment.
Oh, wow.
This means that banks do not need your deposits before they make a loan. The traditional textbook model has it backward.
So they lend first, and the money is created by the very act of lending.
You got it. When you sign the loan agreement, you give the bank a promise to pay them back in the future. In exchange, the bank creates brand new purchasing power in the present.
That completely shatters the illusion. It means the vast majority of the money supply isn't physical coins or paper bills.
Nope.
It's just digital accounting entries, born out of debt.
Physical currency, like the coins and paper bills minted by the government, makes up only a tiny fraction of the total money in the economy.
Like how much?
Well, depending on the country, the overwhelming majority, sometimes upwards of 90%, is this digital book money created by commercial banks.
That is insane.
But the story doesn't stop there, because this newly created money doesn't just, sit with one person. It ripples through the entire system.
In something called the money multiplier effect, right?
Exactly.
Because once that money is created, it starts moving. The person who borrowed the $10,000 doesn't just hold it, they spend it.
Right.
And the person they gave it to puts it in their own bank.
Let's walk through the math simply, because it reveals the true scale of this system. Let's imagine a scenario where banks are required by law to hold 10% of their deposits in reserve.
Okay, 10%.
We call this a fractional reserve system. Now imagine someone walks into a bank with $100 in physical cash and deposits it.
Right.
The bank is required to hold 10%, which is $10, in reserve. That means they are legally allowed to loan out the remaining $90.
Okay, so they find a borrower and they create a new loan for $90.
Yes. And think about what just happened to the total money supply.
Well, the original depositor still sees $100 in their banking app.
Right.
But the new borrower now has $90 of new purchasing power in their hand. So the total money supply just expanded to $190.
And the cycle is just beginning.
Oh, man.
That borrower takes the $90 and buys a bicycle. The bike shop owner takes that $90 and deposits it into their own bank. Let's call it bank number 2.
Okay.
Now, bank number 2 has a new deposit of $90. They must hold 10% in reserve, which is $9.
Right.
So they loan out the remaining $81 to someone else.
And that third person spends the $81, it gets deposited into bank number 3.
Exactly.
Which holds 10%, so $8.10, and loans out the rest.
See how it works?
So one initial deposit essentially clones itself over and over as it bounces between different banks.
This process repeats again and again. That initial $100 deposit ripples through the system, creating new loans at every stop.
Until it hits zero.
Eventually, yes.
Yeah.
But by that time, it has supported a total of $1,000 in the total money supply.
Wait, $100 turns into $1,000.
Mathematically, a 10% reserve requirement allows a single deposit to multiply by a factor of 10.
That's wild.
The banking system as a whole acts as a giant money amplification machine.
But that entire multiplication process relies entirely on the money staying inside the banking system, right?
Yes, it does.
What happens if someone decides they don't want to deposit their cash? Like, what if they take that $81 and just keep it in their wallet?
That exposes a fascinating real-world vulnerability in this entire system. Economists call it mattress savings.
Mattress savings. Literally stuffing it under the mattress.
Literally.
Yeah.
Think about developing economies or regions experiencing severe financial instability where people simply do not trust the banks.
Yeah, where there's a lot of fear.
Right.
Yeah.
Instead of depositing their wages, they take physical cash and actually hide it in their homes, under the mattress, in the walls, buried in the yard.
And when money is pulled out of the banking system like that...
The multiplier effect breaks.
Wow.
The bank never gets that deposit, which means they can't make the next loan, which means the next bank doesn't get their deposit.
So the chain reaction stops.
It stops completely. When mattress savings are high, the total money in the economy actively shrinks, which can choke off economic growth entirely.
But wait, even with this multiplier, if a bank can essentially create money out of thin air by typing on a keyboard, what's stopping them from taking massive gambles? I mean, if they had a magic keyboard, they'd never stop typing. Why don't they just create infinite money and get infinitely rich?
That's the logical question, right?
Mm-hmm.
But banks do not have unlimited power. There are three massive guardrails that prevent them from creating infinite money.
Okay, what's the first one?
The first, and perhaps most complex, is central bank reserves. Think of central bank reserves like casino chips.
Casino chips.
Yeah, you and I might be betting with digital numbers on a banking app all day, but when the banks have to settle up with each other at the end of the day, they need to hand over the actual plastic chips.
Explain how that works when I buy something. Like if I take out a loan to buy a car, my bank has to send that money to the dealership's bank. Are they sending those casino chips?
Precisely. Your bank has to actually transfer funds to the dealership's bank to settle the transaction.
Right.
They do this using these special reserve deposits that only exist at the central bank. If your bank just wildly creates billions of dollars in new loans,
Those borrowers will spend the money.
exactly, and the bank will have to transfer billions of dollars in central bank reserves, the casino chips, to other banks.
And if they don't have enough of those chips?
If they don't have enough chips to settle their accounts at the end of the day, they default. So they can't lend money, they can't back up with reserves during the settlement process.
Okay, that makes sense. It's a physical limitation on a digital process. But what about the government? Surely they're a legal limitation.
That is the second guardrail, regulation. Governments impose strict capital and liquidity requirements.
Okay.
They dictate how much risk a bank can take, and they require them to hold a certain amount of high-quality assets relative to the loans they issue.
Hold on. Capital and liquidity requirements is a lot of finance speak.
Fair enough.
You basically mean the government forces them to keep a certain amount of their own skin in the game, right?
That is the perfect way to look at it. If a bank issues $100 in loans, regulators might force them to hold $10 of their own shareholder money, their capital, as a buffer.
Oh, I see.
If some of those borrowers don't pay the bank back, the loans go bad. That $10 buffer absorbs the loss before the everyday depositors lose a single dime.
So if a bank creates too many loans without having enough of their own skin in the game,
Regulators will step in and shut them down.
and the third guardrail just has to be basic business sense. A loan is only profitable if the person actually pays you back.
Exactly. A loan is an asset to a bank, but a bad loan is a liability.
Right.
If a bank just creates money to lend to anyone who walks in the door, regardless of their credit score, they're going to experience massive defaults.
They'll just bleed money.
The bank will take devastating losses, and eventually it will go bankrupt. So the bank has an inherent need to find reliable borrowers.
Okay, so we've established how money is birthed into existence when a loan is made. But if money is created, it must also be destroyed.
It must.
Let me guess, when the government shreds old paper bills.
No. And this is one of those mind-bending facts that turns your understanding of finance completely upside down. It has nothing to do with shredding paper.
Then how?
Just as lending creates money, repaying a loan destroys money.
Wait, destroy, like it vanishes from the economy.
It vanishes completely.
Yeah, way.
Think about it. Remember, the money was created as an accounting entry, right? A digital liability on the bank's ledger matching the asset of your debt.
Yeah.
When you make a $500 payment on your car loan, your checking account balance goes down by $500 and your loan balance goes down by $500.
Okay.
That $500 doesn't go into a vault. It doesn't get transferred to the bank's profit account. The bank simply reverses the accounting entry.
So they just delete it.
It is literally deleted from the digital ledger. When you pay off a debt, that money vanishes from the total money supply.
That is incredibly counterintuitive.
No.
We are taught that paying off debt is the responsible thing to do to build wealth. But from a macroeconomic perspective, you're telling me my responsible choice is actually shrinking the pool of available currency for everyone else.
Let's ground this in a real-world example to make it concrete.
Yeah, please.
Imagine you are 20 years old and you're getting your very first auto loan for $15,000.
The classic milestone.
Right. You sit down at the dealership, sign the paperwork, and the bank approves it. At that exact second, the bank types $15,000 into existence.
Okay.
You take the keys and drive off in your car. But look at what happens to that money.
It goes to the dealership.
Yes. The dealership takes that newly created $15,000
Hmm.
and they use it to pay their mechanics. They use it to pay their electric bill. They use it to buy more inventory from the manufacturer.
My decision to borrow money literally created the cash that paid someone else's salary this week.
Have you ever noticed this in your own life? Every single time you swipe a credit card for a coffee or take out a student loan to pay for classes or, finance a new laptop, you are actively participating in the creation of the global money supply.
Because my personal debt becomes someone else's income.
Exactly. The barista gets paid, the professor gets paid, the tech company gets paid, all because you were willing to sign a promise to pay the bank back in the future.
If we zoom out to the macroeconomic level, this reveals something deeply profound about our entire system.
Which is,
If our money supply is directly tied to debt, then the health of the entire global economy relies almost entirely on confidence.
and that is why the system can be so incredibly volatile.
Right.
Because money is created by debt, it requires a continuous cycle of borrowing and lending. Think about what happens if confidence evaporates.
Like during a crisis.
Yeah, if a crisis hits and banks get scared, they tighten their standards, they stop lending. This is what we call a credit crunch.
Okay.
If banks aren't issuing new loans, new money stops being created. At the same time, everyday people are still making their monthly payments on their old loans.
And since paying off loans destroys money, if new money isn't being created to replace it, the total money supply actually shrinks.
The total amount of purchasing power in the economy contracts. Businesses can't get loans to expand, they can't pay their suppliers, they have to lay off workers.
Just a domino effect.
People lose their jobs, they stop spending, and the whole economy crashes into a recession. The engine of money creation basically stalls out.
Which explains why central banks are constantly manipulating interest rates in the news.
Exactly.
They are trying to control the speed of this money creation engine.
The central bank acts as the mechanic for this engine. If the economy is running too hot, if inflation is high and prices are rising out of control, the central bank will raise interest rates.
Making borrowing more expensive.
Right, because loans are expensive, fewer people take out mortgages, fewer businesses expand. The creation of new money slows down, which cools off inflation.
Makes sense.
Conversely, if the economy is in a recession, the central bank lowers interest rates. They make borrowing cheap to encourage you to take out loans, which floods the economy with newly created book money, stimulating growth and hiring.
This entire system sounds like a house of cards balancing on a continuous tightrope of debt creation.
It's definitely a balancing act.
What if we just stop the magic trick altogether? What if we force banks to keep 100% of everyone's money in the vault at all times?
It's a fascinating hypothetical, and it's actually a real historical proposal.
Really?
Yeah, back in the 1930s, after the Great Depression, some prominent economists proposed exactly this, a 100% reserve requirement.
Interesting.
Under this system, if you deposit $100, the bank must keep exactly $100 in liquid reserves at the central bank. They cannot lend it out. They cannot multiply it.
Well, the obvious benefit there is absolute safety. A bank run would be mathematically impossible.
Completely impossible.
You could have every single customer show up on the same day demanding their money, and the bank could just hand it to them.
The safety would be ironclad. But the massive trade-off is the complete destruction of maturity transformation.
Right, because they can't lend it out.
If banks can't use your short-term deposits to create long-term loans, how does anyone borrow money?
I guess they couldn't.
To get a 30-year mortgage, the bank would have to find an investor willing to voluntarily lock up their cash for exactly 30 years, completely untouched.
That is incredibly difficult.
Almost impossible. Without the ability to create book money, the flow of credit to households and businesses would slow to an absolute crawl.
Yeah, you couldn't buy a house.
It would be nearly impossible to get a loan to start a business, buy a home, or build a factory. While the banking system would be perfectly safe, economic growth and human progress would be severely stunted.
Here's a question for you. Do you think banks should have the power to create money out of thin air, or should they be legally required to hold 100% of all deposits in reserve, even if it makes it harder to get a loan? Let us know your thoughts in the comments.
It really is the ultimate balancing act. Fractional reserve banking and book money creation allow for rapid innovation, homeownership, and economic expansion.
But it also creates a system where booms and busts are inevitable.
Driven completely by the collective psychology of borrowers and lenders.
Right.
So what's the missing lesson here? What did school forget to teach us? It's that Banks are not just passive vaults acting as middlemen between savers and borrowers.
They are the active engines of money creation.
Exactly. Money is birthed when loans are signed, multiplied as it flows through the economy, and permanently destroyed when debts are paid.
Wow.
The numbers you see in your banking app right now aren't physical objects locked in a safe somewhere. They are essentially a chain of digital promises.
Yeah.
The money in your pocket today only exists because someone else, somewhere, decided to go into debt.
It completely changes how you look at the world, but it also makes you wonder about the future. If banks hold all this power simply because they control the digital ledger, what happens when that ledger is decentralized?
Oh, that's a whole other rabbit hole.
Oh, right. With the rise of cryptocurrencies and decentralized finance, are we about to take this immense power of money creation away from banks entirely, or are we just handing the magic keyboard to someone else?
That is the multi-trillion-dollar question. So the next time you picture money being created, don't think of a printing press in a secure government building. Think of a keyboard, a digital ledger, and the profound power of a signature on a loan agreement.
If you enjoyed this deep dive of the missing lessons, don't forget to follow the show, leave a rating, and share it with a friend. Your support helps us continue exploring the topics school never taught us.